So we all know that one friend that is full of indicators on his chart, and we always wonder, dude, how can you even trade like this? Yes, using indicator is actually very difficult for 90% of traders, and many of the times they don't actually give you enough information to win or to make money, because as you can see, a lot of people have different strategies on how to use them and why to use them. But the reality is almost all of the indicators tell you the same information. Down here, this indicator is almost replicating the same thing that the chart is doing, which shows you that it's actually not giving you too much information. You need to remember that this doesn't mean that your indicator is not working. These are very well known and working indicators that people actually use. But in the middle of every indicator, I found one that actually works. You see, the biggest problem of this indicator is that they move in real time following the market, so you don't even have time to think about it. Yes, you might try to use it in a higher time frame, but that will not actually help you, because the longer the time frame is, the longer you take to make money. And listen, I'm not hating on no indicator, because I know a lot of profitable people that are using these simple indicators. You know, you need to understand that for you to master any topic in the world is because you study something that has to do with that topic. So let's break it down right now. Trading is all about money. What if we started to try to trade money? Instead of trying to trade patterns or indicators, you start trading money, because it's the actual reason why the market moves. But then the big question is, how do we use money to trade? And how can I actually trade with money? You know, there is this particular thing called liquidity in trading. And if you are trading, you probably heard about that. Liquidity is literally money. And if liquidity is money, that means that liquidity is trading, because money is trading. The market will only go up or down because of money. And people don't understand this, but when you see the market rising or dropping, it's immediately showing you that there is money in that direction. When you see the market dropping like this, it means that the market is in a pursuit of money. The market is looking for money. And that's why they created this incredible indicator that shows you liquidity in the market. And it works so well. So let me turn off all the other indicators, because we actually don't need them. And we only need the liquidity indicators. And as you can see, the market rised and dropped. But the question is, why is the market dropping? And if you go back in time around this point, you will see that we had a lot of liquidity down. So this means that this is money, and up here we have less money. All right. So this means that the market is way interested in going down towards the money direction. And this is a beautiful example, because sometimes you will see that the market is not actually interested in taking all the money. It will take the most of it. This right here is a great example. As you can see, there's a lot of money down here and less at the top. And the market will go down to take all that money at the bottom. So as you can see, the market took all the money and we only have a little bit of money at the top. So this means that now it's very clear that the market should be going up, because the money is now up. So when you look at the situation, you understand that now the most liquidity is down here and not up anymore, because we took the most of liquidity. We are in this type of imbalance. What is imbalance in the market? Imbalance is simply that the buyers are big than the sellers. So when the buyers are bigger than the sellers, this is an imbalance, because we know that the market is actually easier to move upwards than downwards. So now that you understand imbalance, let's go back to the charts. So the logic is the same. Now the market will go up because the most liquidity is at the top. But you need to understand that the market is not always looking for taking all the money, but is actually looking for that imbalance. And as you can see, we pushed all the way up here. And when you do this and you try to measure it, you will immediately see that we have an imbalance here because we have a lot of liquidity at the bottom and less liquidity at the top. And what the market is looking for is the imbalance. That means that the sellers, they are waiting for the imbalance for them to step in and be stronger than the buyers. So now that we have the imbalance, this is enough for the sellers to step in and push the market down again. It's easier for the market to drop and take a little bit of that liquidity. And it's basically always the same because when we are in this type of imbalance, small liquidity at the top and a lot of liquidity at the bottom, you will see that the market will not actually need all the money to first go down. The market will indeed go down before taking all the money. And as you can see, this is a perfect example. This time we went all the way down, we took all the money before going back up. And this is why this indicator is one of the unique indicators in the world, and this indicator is used by a lot of professional traders because of how the indicator is perfectly designed.